Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the first installment of our Through the Noise podcast mini-series, where we will talk about our Q2 global market outlook titled Staying Safe. Today we're going to give a broad overview of the investment landscape for investors, and to do this I'm joined by Manpreet Gill, our Chief Investment Officer for Africa, the Middle East and Europe, and he joins us from Dubai. Manpreet, pleasure as always to talk to you. I guess the obvious place to start is it's been quite an eventful month, and we've had a few scares in the financial sector with some sizable banks either being closed or sold, or actually I guess both. And our recession checklist continues to flash red. So risky assets have held up better than you might expect in that environment. So how do you can reconcile the two points?
Hi, Steve. Yes, you're right. It's a bit of a conundrum. And I think what's interesting is that despite what we've seen in the financial sector, all the volatility seems to be more so in government bonds rather than equities, where one might expect it. Now, we think it's a good time to remind ourselves that one of the cornerstones of our investment philosophy is to examine the signal from the outside views. In other words, how historical data or quantitative models or other similar sources can help put these sort of questions in perspective. And today, we think, the viewpoint from our quantitative models, which generally take about a 3 to 6 month view, might actually be helpful as an outside view and help answer that question. Now, the first sort of model we tend to look at is an inflation growth framework. This, of course, uses signals from macro and market variables like the lead economic indicator or money supply growth. And this model today is arguing that growth and inflation are both likely to slow significantly from current levels. Based on this assessment, unsurprisingly, the model is bearish risky assets and bullish on bonds. Now, second framework that we use is a US equity bond market risk model. And this relies a little bit more on major asset class signals rather than just macro data alone. But interestingly, it's similarly bearish equities and bullish bonds. The only silver lining being that it attaches a higher probability, about a 2/3 probability that the environment improves by mid-year to one that's a little bit more constructive, not only for bonds, but also for equities. The third and last sort of framework we look at is a stocks versus bond model. And this one relies on a combination of fundamental, valuation, and technical indicators. Now, this one is bullish equities, but only very mildly so. And all of that really coming from the valuation signal because the fundamental and technical signals are both still bearish. Now, every model has its strengths and weaknesses, but I think where we sit in combining sort of the signal from these models as well as our other analysis is that we're still cautious. We're still looking at about an 80% chance of a US recession in the next 12 months. And we think the Fed may start cutting rates before the end of.
Okay, so what does this mean for investors? Is this the main driver of why you like bonds over equities?
It is one driver. So yes, you're right. We do prefer bonds over equities at this point in time, and that macro framework we described is a cornerstone of that. But I think this is a good time to step back and recall, from the start of the year, we laid out our SAFE framework. And given the backdrop we described, we actually believe the core approach of that SAFE framework remains intact. And just to remind ourselves, SAFE stands for securing one's yield through income assets, high quality bonds, allocating to long-term value through Asian assets, fortifying against further surprises through gold and cash, and expanding beyond the traditional to alternative strategies. Now, that part, of course, is intact, and we're, of course, overweight bonds versus equities. But here, looking ahead to the second quarter, where we've sort of shifted is a position on bonds has become incrementally more cautious. So we're now overweight developed market investment grade government bonds and underweight high yield bonds. This, of course, consistent with the US recessionary view, wherein government bonds typically benefit from the fall in yields and corporate yield premiums over government bonds tend to widen on expectations of worsening credit quality. We've also raised gold to an overweight. This, of course, should benefit not only from the fall in bond yields, but also provide a bit of a hedge given its track record of performing well through economic recessions.
Okay, so what does this mean for a diversified multi-asset income strategy? How do you expect that to perform going forward?
Well, we're still pretty constructive on multi-asset income strategies. We still have, of course, an attractive level of yield, but more than just the yield, we think the strategy's relatively muted volatility in recent months actually demonstrates the value of keeping income baskets diversified. Good example of that is, we had the volatility in junior financial debt, but to some degree, this was, of course, offset by, a rebound in government bonds. But having said that, we have made two adjustments within our multi-asset income strategies. The first is that we have increased the allocation towards bonds. So while the 10-year US government bond yields has declined, yields on other income assets are actually still near the top of the historical range. Historically, high-quality fixed income assets have tended to trough around the last Fed rate hike as markets, of course, start to price in a slowdown and eventual rate cuts. Second is that we've pared back allocation to high dividend equities, given again the recession view. Because while dividend equities can provide some buffer against price declines, we believe high dividend yield equities can't be completely immune to a broader decline in equity markets, given income did contribute about a third of total returns when we look back at the past 3 years.
Okay, so the macro context that you've sort of outlined at a headline level looks like it's a big headwind for equity investors. So how should investors use their equity allocations? Is this sort of more a regional or sector view that you would take?
Absolutely. And I think the key, of course, is to be a little bit more focused or selective, but using that equity allocation well. And a regional allocation is one route we'd use. And here our views remain relatively unchanged from the start of the year. Asia ex-Japan equities is where we continue to see the most attractive risk reward. And of course, Chinese equities within that. Valuations here, we believe they're still inexpensive even after the rebound from October 22 lows. And policymakers very clearly continue to support growth, as we just saw with the most recent cut in bank reserve ratios. Now, here is also worth noting that we're still bearish on the US dollar, which should be a tailwind for Asia Japan equities. A case has been made that dollar should rise if indeed we expect a US recession. But looking at the historical data, the track record is a little bit mixed. And our view here, of course, is that the dollar's eroding yield advantage would most probably be the dominant driver. If we're right here, of course, the weaker dollar can be quite supportive for EM and Asia Japan equities. Now, that's on the regional side, but a second route, of course, we would look at is sector views. And here we have made some changes since the start of the year. Now, in the US, given our recession outlook, we now favor relatively defensive sectors. That's utilities, healthcare, and consumer staples. And we've also closed our overweight on the energy sector, taking profit on a call that has performed well since we initiated it in February 2022. That, of course, on the back of a greater sort of demand-supply surplus in oil markets than we'd initially expected. Over in Europe, we prefer utilities, a similarly defensive sort of view based on a similar sort of view on growth. But in China, we prefer the communication services sectors, consumer discretionary, technology, and industrials. These, of course, are all cyclical sectors that we expect to benefit from that cyclical upturn in growth.
Okay, well, unfortunately, that's all we have time for today. Thanks, Manpreet, for providing your perspective on the outlook. And thank you, listener, for joining us today. As Manpreet alluded to, we see heightened risks of a recession in developed markets, while China is at a different stage of the economic cycle. And on Monday, I will be talking to Rajat Bhattacharya about this in more detail. In the meantime, if you would like to read our quarterly global market outlook in full, you can find it on our Standard Chartered Wealth Insights pages on either LinkedIn or Facebook, or on our SC mobile app, or on our websites under the Market Views on the Go section. In the meantime, thanks again. Have a great weekend, and I look forward to speaking to you again on Monday.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.